Good morning all, and welcome to this Quantuma webinar for matrimonial lawyers on factors affecting businesses in a post-COVID world, with a particular focus on business valuation, tax, liquidity, and solvency issues. Particularly, thank you to so many people for joining us on what's a very hot and sticky day. I shall leave it for our audience to guess how many of us are actually wearing shorts under our business attire on our top halves. For those of you who don't know me, my name is Gavin Pearson and I head the Forensic Accounting and Investigations team here at Quantuma. I'm joined by colleagues from a number of our Quantuma teams. I've got Kate, who is a colleague in the Forensic Accounting team with a particular specialism in matrimonial valuations and providing assistance to family lawyers. We've got Daniel, who is a tax expert with particular focus on SMEs and family-owned businesses. And we've got Yin, who is in our insolvency team. During the webinar today, there is an opportunity to ask questions as we go along, so feel free to enter them in the box. They are anonymous, so we won't be naming anyone. If it's a too technical question, then we'll probably get back to you separately. And if we don't address any of your questions, we'll try and get back to you on those after the webinar. I also apologize in advance. There's always the risk of technical failure during these kind of things. Hopefully we'll avoid that today, but it's always a risk. So the main purpose of today is to look forward and see how the world may look over the coming months and years. But I thought it was probably useful to have a brief recap of what's happened in the last 18 months insofar as impacting the business environment. Yin, starting with you first, probably one of the surprising things since COVID started is there's actually been very few business failures, haven't there?
Yeah, that's correct, Gavin. A lot of people have commented that insolvency professionals should be busy at the moment, but they're actually shocked when it's the complete opposite. The Insolvency Service, they've published monthly stats comparing figures pre-pandemic. So in May 2021, company insolvencies were 25% down from May 2019. And on the personal side of things, bankruptcies were down by 50%. So I think part of the stem of the influx of the insolvencies has been attributed to the government's support systems, the very generous government support systems that have been in place. So we've had the furlough scheme, bounce back loans, CBIL loans, and which have all been unsecured lending, and temporary restrictions have been in place, preventing the issuing of statutory demands and winding up petitions.
Brilliant. Thanks, Yin. Daniel, from a tax perspective, Yin just said, it's been incredibly generous government schemes. To date, the government hasn't really done anything to pay for them, has it?
No, that's right. I mean, again, we all tend to think about the tax rises that may be coming, and we'll be talking about that a bit more later. But for the time being, in addition to heavy government spending, there's actually been tax incentives such as the SDLT holiday, which I think cost about the same amount as inheritance tax raises in half a year, for example, just to provide that incentive. I think the thing is, it's very difficult to start paying for COVID when the economy still needs so much stimulus, and any government faces choking off a recovery if it raises taxes too quickly. So there's a really difficult balancing act that's going to need to come over the next few years of deciding when the economy could stand tax rises versus still needing targeted stimulus to grow sectors that the government wants to protect. And even just in this week's news, we've seen other spending demands not really directly connected to COVID, the social care plan that wasn't, the NHS pay rise that may or may not be happening, and each of those possibly being paid by the same rise in national insurance. So those are all areas which, feed into the picture as well, which just creates a very uncertain environment.
Thanks, Daniel. I imagine we'll be coming back to some of those topics later on. Kate, as you and I have both found, over the last year, valuing businesses has been even more difficult than normal, hasn't it? Because of all the uncertainties.
Yeah, that was exactly what I was going to say, Gavin. I mean, the most significant impact of COVID initially was the uncertainty. Uncertainty reduces business confidence, and that reduces business valuation. So when the first lockdown hit, our corporate finance team reported that deals pretty much stopped overnight for a period of at least 3 months. Companies looking to stabilise their own operations and steady the ship before they went out looking at other opportunities. So just a brief, I expect most people on the call are aware, but most owner-managed business valuations are based on taking a maintainable level of earnings that you expect a business to generate going forward and timesing that by a multiple. The issue for valuing owner-managed businesses straight after COVID, therefore, was the need for them to crystal ball gaze and try and determine what level of income could be achieved going forward. Now, fairly few owner-managed businesses prepare forecasts, and even fewer prepare forecasts we can really rely on. So if we can't forecast, then it's very difficult to say what do we think that maintainable level of earnings is going to be. And if we've got no deals going on, then what kind of multiple should we be applying to those earnings? So those two factors really made it quite a difficult thing to do. I think overall, we could say that many business valuations did decline, particularly given the expected future losses arising from COVID. And I think we can see that when we look at the FTSE 100 and FTSE 250 indices, looking at the prices or valuations of the biggest companies in the UK. They both dropped by about 1/3 as soon as the UK lockdown was announced, and then they've gradually risen since then. So FTSE 100 is now to within about 10% of where it was pre-COVID, and the FTSE 250 is actually just above it. But of course, that's a generic comment because some industries have fared much better than others.
And perhaps that's something we'll again come back to later in terms of specific industries and how they've done. At this point in the webinar, I was originally going to talk about the world normalizing and how things looked. Unfortunately, despite Freedom Day, this week it's all looking a bit more uncertain, and actually for some businesses who are very reliant on staff, even more so. But so looking forward, Yin, in terms of government support, that's all starting to wind down and come to an end, is that right?
Oh yes, definitely. Well, currently it is. So at the end of September, we'll see two important government measures stopped. Firstly, we've got the furlough scheme that's been in place since April 2020. This has been extended 4 times already. So it's now gradually winding down, and the government have said that it will conclude at the end of September. The temporary restrictions preventing creditors on issuing a winding up petition or a statutory demand over so-called pandemic debts, they'll be lifted at the end of September too. But however, landlords with current commercial tenants who are currently not receiving rent, they won't be able to do anything until March 2022, when the moratorium will be lifted. So yeah, the gradual wind down has already started to accelerate in September and ending in March 2022. Of course, this is, as I said, current, and though the government may announce further extensions in the coming months.
And presumably that combination of an end of government support combined with the fact that a lot of businesses have had to take on debt to get through the last 18 months, presumably means that the insolvency profession is expecting quite an upturn in the coming months.
Oh, of course, Gavin. Yeah, the question is when. As you've already mentioned, we've seen Freedom Day this week, when businesses have opened up without social restrictions, such as nightclubs and hospitality. But is it too late? We will see. You know, no doubt in the coming months. There's also now the pingdemic issue, with businesses that are hit with the self-isolation crisis. So a classic example being Andrew Lloyd Webber's theatres opening and closing on the same day. So sadly, Cinderella will not be going to the ball. He's not a happy bunny, and there'll be more like him in the same boat. And then talking of boats, there's the ongoing problems with international travel affecting the tourism sector. So where the government appears to be changing their mind constantly with confusing rule changes. So it is anticipated that businesses will fail and levels of unemployment will rise, and this will naturally place additional strain on personal finances, resulting in increased personal insolvency figures. An interesting point though, Gavin, is that most people in the industry think that the wave of insolvencies, they're likely to hit early next year.
Okay, well, there's a lot of food for thought there. I have to say, actually, that, you know, I thought we're done with new words that had come out of the pandemic, but the pingdemic is, you know, a whole new, and the associated ping-related words is a whole new topic. In terms of companies and the fact that, you know, a lot of businesses have taken on more debt, this is quite important for valuation, isn't it, Kate, when you're valuing the equity in a business?
Yes, it is. Many business valuations have reduced as a result of debt that's been taken on to support them through this difficult time. I think perhaps the best way to explain that is to consider an example. So if we assume that we're looking at a business that generated a very stable level of profits before the pandemic, let's say it was shut for a year because of lockdowns, etc., and now we're back generating the same level of profits as before. Would the value of that business be the same? Well, if we look at the maintainable earnings, then we would say, well, yeah, okay, fine, it should be the same. And if there's no particular reason to change the multiple, we'll park that one for now, but let's assume it's the same multiple, then actually we would be saying the same, the value has the same enterprise value. Now, enterprise value is the value attributable to both the providers of debt and providers of equity. So when we're trying to calculate the value of shares, we need to deduct the value of any debt provided by third parties. So if, for example, this business has taken out debt to fund its overheads, its rent, and maybe other costs during closure, then the valuation will have reduced because it needs to pay that debt back, and that needs to be deducted in calculating the equity value. There are some cases where they might not have taken on any debt, but the value still may have reduced. And that could be if a company had been sitting on a big pile of cash before COVID, but it's now spent most of that cash. So in that situation, balance sheet's reduced and the valuation has also reduced. One point just to mention, I've been quite surprised the number of businesses I've seen that have taken out CBILS loans and actually not used them. They've almost kind of said, well, it's just a bit of free cash. It doesn't cost me anything for a year. I'll stick it in the bank and wait and see. So in that case, there would be no impact on the valuation, because whilst you might have 100 grand of extra debt on the one hand, you've got 100 grand of cash in the bank, so they'll cancel each other out.
Yeah, and I think this is a very live issue, because I saw this recently on a case where, you know, a business, as well as having uncertainty, also had a lot more debt on its balance sheet, which meant the value of equity had fallen significantly. So it is a very live issue in family valuations. Daniel, the elephant in the room, and probably something that most people on the webinar will be most interested in, which you touched on earlier, is, you know, clearly you can't crystal ball on this, but, you know, how do you think the government's going to pay for all this expenditure that's been incurred and continues to be incurred?
Yeah, I mean, it's much obviously a question of what's politically possible as what's economically sensible. And I suppose just to illustrate the thinking about this, when I've spoken at events like this over the last year, I've tended to run a poll which sort of asks when people think taxes will rise, you know, assuming they will rise. And if you offer the three options of in the next year, in a year's time, or in 5 years' time, the split is very much, you know, 5%, 80%, 15%, with the 85% on in a year's time. Now, the key point is it's always in a year's time, no matter how many years go past whilst you're running the poll. And unfortunately, I think that thinking is probably very similar in government, that tax rises are painful. They are a lot easier to announce in a year's time or 2 years' time, as we can, for example, see with the corporation tax rise recently announced, which won't come into effect until after the next general election. I think the betting would be that it may suddenly be quite difficult to actually implement that when we get there. But the challenge the government really has here is that on some level, one day things will need to be paid for, and the only taxes that really raise large amounts of revenue without gigantic headline rises are income tax, national insurance, and VAT. And it is very hard to see a path where the current government can raise those taxes with its current backbenchers and the attitudes there. So what that means in practice is probably that we will be looking at a fair amount of tinkering with tax loopholes and reliefs, which are perhaps a little less known and less visible, in order to try and bring in some extra revenue. But actually, as a result, an increasingly complex tax system, focusing on rises that target relatively few people and don't create an overall unpopular effect. Again, that can't carry on forever. It doesn't raise enough money, but it can probably carry on for quite a long time. And again, once it really just contributes to this uncertain tax environment where a lot of details change because there's a need to be just finding bits of revenue here and there.
And thinking of our audience today, who are family lawyers, a lot of these tax changes are going to be quite relevant for separating couples potentially, aren't they, in terms of both splitting assets and in terms of estimating income going forward?
Oh, absolutely, and for two reasons. I mean, we've seen in recent tax changes that it's as much about the government showing whose side it's on as it is about raising revenue, and targeting capital taxes, as we saw with reduction in entrepreneurs relief as it was then, is as much as a political symbol as a revenue raising measure. So we can see that for the kind of matters we are all concerned with, that targets like inheritance tax reliefs, capital gains tax reliefs, stamp duty are popular ways to raise revenue which don't affect that many people in the wider electorate, but have potentially a very large effect on the value of matrimonial assets when looking to divide them and potentially crystallize gains. So again, not necessarily changes to headline rates, although I wouldn't rule out the CGT rate moving closer to the far higher income tax rate. But in terms of reliefs being removed, which make a really big difference to the amount of tax actually paid, then I think there's a big risk that there will be changes of that nature in the coming years.
And coming back to valuations, Kate, we've obviously touched on debt, but I think both you and I have probably found that there's other factors that are continuing to make it difficult to value certain businesses at the current time, aren't there?
Yeah, and I think really, Gavin, we're there again back to your opening comment with regard to uncertainty. Yesterday, I issued a report looking at a business with significant exposure to the airline sector. So, how's that going to recover? Is it going to get back to pre-COVID levels? Has our attitude to travelling changed? There might be some pent-up demand. There might be some reluctance. Question whether Zoom's going to have an impact on business travel. I mean, we don't really know, and the client doesn't know. So in that situation, we've got to try and make a reasonable assessment as to how the business might perform in the future, both in terms of maintainable earnings and the multiple it can command. Now, of course, that business has managed to continue trading, but there are some businesses, particularly in the leisure and hospitality industries, which ceased trading for a large part of last year and early this year. And that makes it very difficult to consider what the income might be going forward, whether or not demand is going to return for the services that they provide. So as I mentioned before, forecasts in this circumstance are pretty rare, and robust forecasts are even rarer. And many businesses are saying to me, well, why would I bother forecasting? As Yin mentioned earlier, the government's changing the rules overnight, and that can suddenly mean they've spent a week putting together a forecast that they then have to throw out. So as single joint expert, we are very much left trying to assess when and if future maintainable earnings will return to pre-COVID levels in a situation where the current and recent history is exceptional. So the real challenge for us lies in trying to determine to what extent historic results are representative of the future.
It's funny because I think that there's a lot of people who are business valuers who might say it's more an art than a science. I've never really liked that phrase because actually it's quite a scientific process with judgments involved. But I think what's changed is there's more and more judgments that are needing to be made by valuers compared to 2 years ago. So Kate, in terms of your approach to valuation, would you say you're approaching things slightly differently now to you were pre-COVID?
Yeah, I think that would be fair to say. I mean, as you say, it's always been a case of looking at what is the right approach for each business. But now I think the valuation approaches are more varied and they need to be tailored more to specific circumstances. And as you say, Gavin, we're much more reliant on assumptions, and nobody is going to actually be able to say until we can look back with hindsight in 3 years' time whether those assumptions were accurate or not. But all we can do is make them as robust as we can. Now, from a theoretical perspective, the ideal approach here would be to use what's called a discounted cash flow calculation to value a business. So what that does is it looks at cash flows into the future so that you can build the recovery through COVID. So rather than taking a consistent level of maintainable earnings, you might say, oh, it's 50 this year, 100 the year after, etc., etc. Now, the problem with that is, as I harking back to, that we don't necessarily have those cash flow forecasts, and it's quite difficult to put anything together. And in addition to that, trying to determine discount rates for fairly small owner-managed businesses is far less robust than using a multiple of earnings, because that's not actually the way that businesses are in fact bought and sold in this marketplace. So the pragmatic approach that I've tended to adopt is to use the maintainable earnings times a multiple approach, but to consider the extent to which we anticipate or reasonably anticipate future losses are going to be generated as a result of COVID, and then we can quantify that and take it into account in the valuation. Just on multiples briefly, we do have some post-COVID deals now, which give us data showing how multiples have been affected. Overall, they don't seem to have been as severely affected as we might have thought initially, and as I was suggesting by reference to the FTSE indices earlier. But of course, it's very important to remember that we need to look at the specific sector in which a business operates, and also we need to look at the specific circumstances affecting each individual business.
And following on with the uncertainty, often in instructions in matrimonial matters, our primary task is valuing the business, but we're very often also asked to look at what income a spouse can derive from a business going forward. Kate, would you agree that a lot of the same issues that make valuation difficult also make it difficult to predict that future income flow, even before you get to the issues Daniel's flagged, which is that the tax impact on that might change. But in terms of the actual income flow, there's uncertainty there as well, isn't there?
Yeah, there is. And the way that we usually look at that level of income is by reference to the maintainable earnings we're calculating for the purposes of valuation. So that what we tend to be reporting, and what I tend to say in my reports, is that is really the maximum level of expected sustainable income. This is really an area that I think the audience, instructing solicitors in particular, will be, really quite focused on, and is really very important for them, is to consider exactly what it is they want us to tell them in terms of maintainable income. Is it the long-term position? Is it the short-term position? Do they want a sort of, immediate term versus longer term answer? As single joint expert, it can be quite difficult to know exactly what the court wants there, and it's difficult to ask the parties because, as you can imagine, you will tend to get two very divergent answers from two different sets of instructing solicitors. So I think that's one to really focus on for our instructions.
Okay, and still looking forward and adding to the uncertainty, I think I saw a survey this week that more than 70% of people expect there to be a further lockdown at some point this winter. That survey, I think, may have been from the Daily Mail, so it may not be particularly trustworthy. But looking at it from an insolvency perspective, Yin, presumably another lockdown could be the final nail in the coffin for a lot of businesses.
Yeah, Gavin. So let's say we're anticipating a lockdown in, say, October. Most of the government support systems that I talked about earlier, they will have been withdrawn, unless obviously the government changes its mind again. The Band-Aid has been ripped off, and there is no doubt that insolvencies will rise. At this point, I think we should also look at an insolvent company that forms part of the assets of the matrimonial pot. If a company was profitable pre-pandemic, new valuations will need to be obtained because historical valuations can't be relied upon, and obviously the pot of assets will be depleted.
And Kate, from a valuation perspective, that would mean you get more uncertainty and more difficulties, and it's something that is very difficult to factor into a valuation as of today because we just don't know if it will happen.
Yeah, I mean, absolutely, it is an issue. It's a real risk, and the way that we would tend to deal with that sort of risk is to address it in the multiple that we apply to our maintainable earnings. I think one point that is worth mentioning here, though, is that we just need to be careful and think about whether or not it's already been priced in to the reference multiples that we're using. So, for example, if we're looking at listed businesses, it's fair enough, you would expect the share prices of those businesses to reflect the risk of future lockdowns, as is currently anticipated. So we just want to make sure that we don't sort of triple count the effect of COVID by, for example, putting a very low maintainable income level on the business and applying a very, very low multiple and deducting a great whack of expected future losses from COVID. And this is one of the things we really need to think about when we're doing our valuations, because every single valuation will be different and we'll need to take a different approach to that.
And Daniel, from a tax perspective, there's another lockdown. Well, there's probably not much you can add to what you said earlier, but presumably a further need for spending would give more problems to the public purse.
Yeah, and I'm just thinking whether we're actually quadruple counting if we also factor in higher tax rates into any further sort of valuation. But there's some interesting points. I mean, thinking about Yin's comment about ripping off the band-aid of support, it does seem at least plausible at the moment that the government will be wedded to this idea that things are now normal, and therefore tax rises they've held off from making over the last year or two will just go ahead regardless of the fundamentals. I think they're just thinking a little bit more practically rather than conceptually about different taxes and bigger policy. The thing to think about, particularly for our audience today, is how do you actually apply this in practice? What sort of choices are made? Because to state the obvious, there's no natural post-tax value of an asset if it's being disposed of. It depends entirely on the specifics of a transaction, whether tax is crystallized or not, whether there's the money to pay for it. But clearly at the moment we if we see kind of an uncertain future, possibly with a lot of tax rise inherent in assets, there may be real value to crystallizing tax at rates we know now, rather than say taking on an asset which has an unknown future tax liability. I think just making a judgment about what that asset is worth, if one knows that a large proportion of its value is subject to tax in future, is very difficult, because we don't know what that tax rate will be. So even if it's not a question of quantifying all tax, at least making sure that both parties have a kind of symmetrical exposure to the same kind of future tax rises may be quite important to achieve any kind of equitable outcome.
Brilliant. Thanks very much, guys. We started to get some questions come in. And if anyone's got any others, do type those in to the questions and answers box, and we'll deal with as many as we can. We've had a few specifically about COVID-related issues, but first of all, a general one that's come in that I'll try and answer and then pass over to Kate, which is someone who's asked how we decide the multiple in valuations. Where do we derive multiples from? Obviously, we don't want to give away too many of our secrets, because we don't want to do ourselves out of a job. But in principle, obviously, with a multiple, what we're trying to do is derive something that's appropriate to the company that we're valuing. So comparability is very important. So we might look in principle at general indices for all companies. For example, BDO prepare a report called the PCPI. There's a report called the UK 200 SME Index, but they just refer to all companies that were bought and sold in the most recent period that the report covers. What we will much more do is look at corporate finance databases in order to identify both potentially listed companies in a similar sector, but you have to be very careful with listed companies because they're often a lot larger, and they are also, because they're listed, there is liquidity in their shares, etc. So for SMEs, that's not generally that useful. What we're often much more interested in is looking at actual sale of businesses that we can access the data for, so we can see the multiples that were achieved on those. And we'll be trying to look for businesses that are as comparable as possible, albeit we'll need to factor in the factors specific to the company that we're valuing. Kate, anything to add on that?
Yeah, I think just picking up on your last point about factoring in points that are relevant to the company, I had a case a number of years ago that I think just sort of demonstrates one of those factors. And one of them is the reliance. If you have a company that's significantly reliant on a very small number of customers, in this particular case, it was a facilities management business. And the month before I was asked to do my valuation, they had received notice from their largest customer, which represented 45% of the business, that they were terminating their contract. So within 3 months, 45% of the business would be gone, along with the employees who were actually going to TUPE across to the new to the customer. So in that situation, you know, that fact had a very, very significant impact on the valuation of the business. And so that is the sort of thing that we need to consider when we are making adjustments to multiples that we derive from the sorts of sources that Gavin mentioned, to make sure that we're really trying to apply the risks associated with the current company when we're looking at that multiple.
Well, and the other thing to say is that we have experience of other valuations we've done in similar sectors, and through our corporate finance colleagues at Quantuma, we have access to actual data that of transactions they've undertaken. So whilst we might not always be able to quote those by name, it does help us in arriving at a suitable multiple. A question on a slightly different theme. I'm not sure if this is one for Daniel or for Yin. If companies are sitting on lots of liquid assets that haven't yet been distributed to shareholders, could potential changes to capital gains tax mean there's benefit to liquidating those companies and distributing the assets now?
Yin, do you want to start, or shall I on that?
We don't know if there's going to be a tax rise, but the message I would say is that with any financial situation in a company or an individual, advice should actually be sought early in the process. So the earlier the advice is sought, the more options that will be available. That's my view.
Yeah, well, I'm very happy to agree with that view, obviously, but certainly I'm sure everyone has their horror stories of a tax advisor telling them about the amazing things they could have done last year if only someone had taken advice before making irreversible decisions. But I think on this particular idea about extracting cash, there's a few things that are worth noting. I mean, the first is that the benefit, the potential prize, is very large. I mean, you can, at the extremes, you could see a situation where liquidating a company and extracting liquid assets could be taxed as low as 10% for someone who's benefiting from their business assets disposal relief on the first million of gains. If it's normal capital gains, you're still only at 20% tax, whereas something coming out of the dividends, 38, other forms of income could be as much as 45%. So that's a massive proportion of the value which could be taxed at a lower rate and then available. But there are other things really need to be thought about. I mean, the first one is the obvious one is, do the assets actually need to be extracted from the vehicle at all? Because actually, if the relevant party is very happy investing in that vehicle for the next 20 or 30 years, there's probably not a lot of benefit in triggering a tax charge, which may never actually have to be triggered, rather than growing a larger amount. The other thing is that there is a lot of anti-avoidance in this area, and without getting into the kind of detail that none of us will enjoy at this time in the morning, it basically says that if you try to liquidate a business and then carry on running it after having taken out the cash and paid capital gains tax, then one of 3 different rules will basically get you and make sure that you do pay income tax on it. Basically, HMRC are incredibly unhappy with the idea that anybody can take out something which is in substance a distribution from the profits of an ongoing business and then carry on running the business. So a capital gains play really is a one-off thing. So with the caveats that if the money is there and it's sitting in a vehicle which is no longer looking to use that money, and the owners would prefer the money outside to use personally or invest in a different way, then looking to crystallize now, I think, is a very sensible idea, because it's very hard to see those tax rates going down, and they will almost certainly go up. But there are a lot of things to work through, and I again come back to where Yin started, which is think about it as early as possible, make a plan as early as possible before executing it.
Okay, thanks, Daniel and Yin. Do keep the questions coming in, because I think we do have time for a few more. Another one that's come in is in relation to the buzzword probably for today, which is uncertainty, and whether there's been matters where that uncertainty meant we just couldn't value a business. Kate, I'll ask you in a minute, but my experience has been that there's been cases where uncertainties made it very difficult, and I've had to outline those uncertainties and set out for the court effectively what the different possibilities might be. but not to the point of impossibility. What's your experience been, Kate?
Yeah, I haven't had a situation where I've had to say I absolutely can't do it. I think the only time you'd say you absolutely can't do it is where you have no financial information. So you just can't put a number on it. I think that generally we would always be able to at least work out what the value would be, for example, on a liquidation basis or by reference to a company's assets, even if we simply can't say what we think a maintainable level of income might be for that business. So I think we could always come up with a value, but that value may be a lower value than might have been the case at another time. Okay,
and another question probably for you, Kate. Someone's asked about sectors that have done particularly well since the start of the pandemic. It's ironic having this webinar on a Zoom when, you know, that's one of the most obvious businesses, along with manufacturers of gym equipment and some other sectors. But if you're valuing a business, to what extent do you treat improvements over the last year as permanent or going to return to normal?
It's a very tricky one, really, and I think it comes really down to something that we spend quite a lot of time doing on our reports, which is researching the marketplace that we are of the business that we are looking at. So in terms of trying to understand to what extent a change is permanent, which I suspect that the Zoom change is going to be permanent to some extent. I don't think we'll be zipping off to meetings in the States very frequently anymore, or giving evidence in person in Hong Kong. Or whether it's likely to be a temporary sort of, uptick. So I think really, there will be some of those businesses, the technology and probably logistics, I suspect will have a fairly permanent change, because I think things like our shopping habits, that's been reported quite a lot recently in the press, that's likely to have taken a real permanent shift online as opposed to just a temporary one. We're not going to go back to visiting the high street quite as much as we used to, and we've all found Amazon extremely convenient. So I think it's again down to the individual business and the research that we need to undertake in relation to those.
Okay, Daniel, following on from your earlier comments, there's been a question about the extent to which other assets like property, I think is probably the one that people are most interested in, can be easily extracted, effectively demerged from a business. Is that something that's easy to do or particularly practical, or?
It is practical. It's not particularly easy to do, but there are routes to get it done. I mean, first of all, starting with the bad news side of it, it's important to say that if there are assets like property in a company and the shareholders want to own those assets entirely personally, then that is one of the issues that I was previously talking about that will probably trigger an income tax charge, but certainly a capital gains tax charge. What we can do, however, is go through a demerger process, which is essentially tax neutral, using various reliefs that are available in combination. And the end state of that would be two separate companies, where the shareholders of the original company directly own shares in both companies, but say with property in one and a trading business in another, for example. So clearly that can be very useful simply for separating out assets without triggering any kind of tax charge. But the other value of it is often for other elements of indirect tax planning, which are quite important as part of this wider process. So, for example, the mix of assets in a company can threaten the availability of business property relief, meaning that the whole value of the company is subject to inheritance tax in the estate of the shareholders, or it can maybe threaten the availability of capital gains tax reliefs, such as entrepreneurs relief. So a common technique is to demerge the company and then put the kind of bad assets in inverted commas in one company which won't get any relief, but make sure the good assets are in a good company that qualifies for relief. And that isn't just a sort of neutral planning situation. You can obviously see that in a case where assets are being divided and distributed, some of the changes that take place could themselves impact the tax status of companies in respect of these reliefs. And so then as a further stage of planning, a demerger might be a good technique to make sure that what is left in each party's hands has the optimum inheritance tax and capital gains tax treatment going forward.
Okay.
Yeah, and sorry, Gavin, just to sort of butt it, I mean, I was just going to give an example where Daniel helped me a couple of months ago with an SJE report where I was specifically asked about whether or what options were available to the parties in respect of a group that had a subsidiary owning a property from which a separate two subsidiaries that were manufacturing businesses operated from. So actually, you know, that demerger option there was by far the most tax efficient means of extracting the property from the group. And yeah, I don't always know the reason behind my instructions, but I assume that there was possibly some reason for asking that in terms of looking at the ways of dividing up the assets between the parties.
And I guess that's a good illustration of why tax isn't just a zero-sum game. You know, by undertaking a transaction like that, the total post-tax value of the assets is a huge amount higher than it would be if a more conventional distribution had taken place. And so it isn't simply that one party's share is worth more and the other is less. There's actual value created.
Brilliant. And funny enough, another question, which unless we get any more will be the final question, is a more generic question about property in valuations. And basically the scope of the question is that where we're valuing companies that own a property which is actually being used in the business, why do we sometimes want to know about potential developmental value, or why do we care what the market rent is? From my perspective, in most business valuations where they occupy a property and it's assumed that will be ongoing, then generally one's, you know, will just assume that that's just the way the business operates, and that asset is part of the business assets effectively, and therefore needed for the operation of the business. I think I have come across exceptions, and I'll ask Kate her experiences too, where a business might have a property which actually it could sell for development and make a large profit, and then rent a similar premises for a much lower cost. And sometimes in those situations, it is relevant to take account effectively of the asset and then look separately at what it would cost to rent a comparable property. However, I would be very careful in terms of instructions I received in terms of adopting that approach, because you know, that goes, in my view, slightly beyond the scope of a business valuer. But if I thought there was potential additional value there, I'd certainly refer to it. Kate, what would your view be?
Yeah, I mean, I think it is relevant to consider, because if you take, you know, say you take the extreme example where a company is operating from a site that could be sold for development. And I did do a valuation a couple of years ago where there was a large old factory site just outside Hatfield that was apparently in a sort of residential area. We did actually look at Google Maps, and it did look to be the case. But the valuation was saying, well, actually, that this could be sold, and you know, a small development of properties could be built on it. In that situation, I think the concern would be that ignoring that value would mean that you could, let's say I go to buy the company and that development value has been ignored, then actually I buy the company, I get that property, I then can start sell it for development the next day, and you know, get myself a nice windfall of however many £1 million, and just rent another site elsewhere. So I think it really is relevant to consider it. But I agree with you, Gavin, that it's really, particularly with regard to the development value, we need to consider what our instructions are. With regard to sort of a business that owns a property, it's relevant to know what's the market rate of rent of that property to make an adjustment for what that would be. Because if we consider two sort of hypothetical companies that perhaps might generate the same amount of profit, and one that owns a property and one that doesn't, now if the company that owns the property is not going to be paying any rent, so its profits are arguably overstated on an arm's length basis. And if I was to buy that company, presumably, if I was to buy the company and it didn't have the property, somebody would be expecting to charge me a market rate of rent. So I need to consider what that rate of rent is, whilst also considering the value of the property. Because two identically profitable companies, one with a property and one without, you would definitely want to be having the one with the property if you don't make some kind of allowance in the valuation for that additional value.
Okay, thanks, Kate. And one final accounting question that's just come in relation to if a company has significantly more cash coming into its bank account in a year than its reported turnover figures. And the question says, even accounting for loans and inter-account transfers, what reasons could there be for that? I mean, I think there is an important point to make here, which is that cash and turnover or profit are not the same thing. And you can look at a lot of company accounts and see profit in a year, for example, and then see a cash outflow in the year. In terms of money coming in, it could be, for example, that they had trade debtors which were outstanding at the year end and have been recovered in the current year. It might be that they've sold assets. It could be that, although the question says not, a loan coming in. Kate, you can probably think of some other examples as well.
Well, possibly if you've got somebody paying a large amount up front for something, so a big payment on account for services that haven't yet been rendered. I'm not sure if that was in the question or not, as already having been taken into account. But in that situation, you receive a lot of cash, so you can probably imagine, if as practicing solicitors, if somebody pays you a very large sum on the last day of your financial year in respect of work you're going to do, but you haven't yet done, that's going to improve the cash balance of the business. But you're not going to recognize that as turnover yet because you haven't done the work.
And Daniel presumed it could hypothetically be a tax rebate.
It could, yeah, definitely, or just a refund of overpaid tax, honestly. I mean, as a final plug, it could obviously be something like an R&D tax credit relief, which are repayable if people make R&D claims, and so that wouldn't show as turnover in a small or medium enterprise, but it would be hopefully a good pile of cash coming in. Brilliant.
Okay, and I think that probably brings us to the end of today's webinar. Thank you very much to everyone who joined us. It was very pleasing to see that the number of participants stayed up right the way through, despite the heat and possibly the slightly dry topics we were covering. A particularly big thanks to Kate, Daniel and Yin for imparting their wisdom. Do have a look at our website, which is www.quantuma.com, which will tell you a bit more about us, and you can see our lovely photos and contact details on the current slide. If there is anything you'd like to discuss, then feel free to contact any of us, and have a good day, everyone. Thank you very much.
Thanks.
Thank you.
Thank you.